Man, what a great Thursday. Did a ton of work. Got the Elder Law Report film, saw clients, and also worked on, wrote a couple of articles for newspapers, and started back doing the Lawyer Greg Rockstar Lawyer podcast with Robert. Did a really good one called Don't Dilute the Scotch, and I'll include a little bit of that podcast in the Real Deal today. It's Greg McIntyre, Lawyer Greg, the Elder Law guy with the Elder Law Report, and I have a great topic for you here today, and it's the 2018 tax laws, which I need to know with what I do, right, with estate planning. And the last time I had a question about the tax laws a few years back, Robbie set me straight. I mean, I could spit out those gifting, how they work at death or in life, you know, and you're the one that set me straight on all that, right?
I remember.
Because when I need to know something, I go to someone who's in the know, and Robbie happens to be an accountant, and among other things, right? And really good with taxes, right? So does that for individuals and businesses. So we're very blessed to have Robbie Reynolds here today to comment on those issues. Do we have somebody? We have
your beautiful, beautiful wife.
Yes.
Live and in person.
And Hayden,
Yes.
will you pay my taxes for me next year?
Well, sure. Of course.
Sure?
Yeah.
Now, I don't know what the tax laws are yet, so we're going to find out today, okay? So I wouldn't say yes yet, right? Yeah. I think if you don't make up to $25,000, you don't have to pay any taxes, so maybe I can just pay myself less than that. I don't know. But how does it affect us? How does it affect our businesses? How does it affect us individually? How does it affect a senior and their families? I don't know, but I think Robbie's going to get into that today. Hey, did you have a happy place or anything prepared today?
No, I didn't. I thought I was going to. I was going to get a list of all the crazy taxes we have to pay. And then I started reading, and it got sober instead of the least bit happy. But the one thing that I think caught my attention, I have a granddaughter going to college this coming fall, and Greg has a son who's going to college. And I just happened to look at the gift tax. No, or university. No, okay. I think my granddaughter's going to the University of Tennessee. Because she's got scholarship money, and she's been working with her guidance counselors forever, so they've got that all figured out. But some scholarship money can be taxable, depending on what you spend it on. I just found that in my computer. It depends on whether you spend it on at an accredited school, and if it covers tuition, books, fees, or school supplies. That money is tax-free, but if it goes to travel, housing, or other miscellaneous expenses, then it's taxable. So things like
Definitely
that
something
are
that
good to know
parents
before
or
you don't.
grandparents should do.
Yeah, and these people who win the makeover housing and all this kind of stuff, all of that is taxable if it's over $14,000 or something like that. So you may assume anything you want to. You may assume in your position, you know how people have assumed and how it's gotten them into trouble. They didn't think they needed this, or it didn't apply to them. So it's better to ask and get an answer from a professional than to assume. So we have a professional here.
I know. So better to knowledge is power, right? So,
Absolutely.
So we're going to get some knowledge. So Robbie, thank you for being here with us today. I appreciate it. Well, let's get down to it. So there's a new tax law in 2018, and my fear is that it canceled out everything I already know about taxes and how I'm planning. So what should we know?
Well, it didn't cancel everything out. It changed a lot of things.
Okay.
It changed a lot of things if you're a business. The way some of that income is going to be taxed, particularly if you're in a type of business that's sole proprietorship, a partnership, or LLC, or an S corporation, where profit is going to pass through to the business owner. The tax on that income is going to be significantly different than it has been in past years.
Okay.
Don't know for sure whether it's going to be better or worse. Some of the analysis we've done so far, it doesn't make much difference. Some, it makes a lot of difference. So it all depends on the individual situation. All that money ends up being taxed on your personal return, and the changes on the personal return don't seem to have a lot of big differences unless you're way on the top end or way down on the bottom end, income-wise. the tax brackets have gone down some, so generally we tend to be going to pay a little bit less in tax. Our standard deduction is going up, so most of us won't have to itemize our deductions, and we'll be in the same position, but we're losing our exemptions. So someone who has 6 children is going to have an increase in their taxable income because they won't have a $4,000 deduction for each of those dependents.
Wow.
That's not good.
24K.
That's not good.
I don't like that.
No.
That may discourage the birth rate.
Big-
What we're looking at now is a less than 2.0 per family.
Mhm.
We're not reproducing in some cases, so that's gonna get worse.
So that's going to have an effect. The child care credit, or the child credit for each child under 17 is going to go up by $1,000. And a good portion of that is going to be refundable in certain situations,
Right.
depending on what income limitations apply. A lot of the income limitations that in 2017 and before prevented a lot of people from really taking advantage of these. Those income limitations are going to increase, so that it'll be more available to more taxpayers altogether.
So pretty much I'm gonna have to pay $24,000 more in taxes.
No, I didn't say that.
They're
Yeah.
saying the
We're
other
going to lose
lose that deduction.
deductions of $24,000.
Was I right that if you make up to, you're not taxed up to $25,000 in income? Is that right? Is that what I heard?
If you're married and you're filing a joint return,
Yes.
then if you have income of $25,000,
Okay.
then your tax rate should be 0,
Cool.
or maybe 10% of
Right.
1,000.
Okay.
It's almost 0.
How does that compare with what the old rate was?
Well, at $24,000 previously, depending on what your exemptions and itemized deductions were, you probably would have paid 10% of the difference between $24,000 and say maybe $12,000. So you pay $1,200 compared to $100 on the very.
I'm sorry, we got you off track there.
So Robert,
Yes.
what's up, man? We've been off here for a little bit, but coming back with a strong podcast. Don't delete the scotch. Don't dilute the scotch.
Don't dilute the scotch.
That's right.
What are
You
you
can't-
talking about, man?
You can't delete the scotch. Don't dilute the scotch, right? So what does don't dilute the scotch mean? Well, someone said that to me. I think it was Bob Demers mentioned it to me about something one time, and it's very, very relevant to what I've been working on over the last quarter, the first quarter of 2018, which is something I've been prone to do in the past, and I think many, many others are prone to do out there, which is focus on one thing for a little bit and then get distracted, squirrel, and go over here and do this, and there's this opportunity over here, yeah, but there's this opportunity over here.
Spreading yourself.
You're spreading yourself too thin. You're diluting the scotch, right? And nobody likes diluted scotch.
No.
Why would you do that? You got good scotch, right? And so what that relates to is focus, right? So this quarter in my planning, and working with my business coach, right? I'm doing my planning. We nailed down 3 specific things that I'm working on. One is completing a book. One is paying off all the bills related to the move-in for this building, okay, to the new building. And one is finishing up some online sales funnels that we're creating, okay, and working with a contractor in France to do it, in Paris. And we're working with a contractor in Nairobi, Kenya, to finish up